Welcome to Borrow by Build. I'm Matty Loans, your trusty loan officer of the past 20 years, hopefully not for the next 20. See, change is in the air, and soon I'll be replaced and my services rendered obsolete. So let me be the first to thank you and welcome you to the show. See, there's an emerging trend in the financial services industry that I trust will soon impact the mortgage business. Currently, one of the most significant headlines of 2025 was Rocket Company's merger with Mr. Cooper and Redfin. Many industry experts believe this merger is beyond consolidation, but a dynamic that will reshape the mortgage market forever. It's unprecedented for a mortgage company to join forces with an online real estate firm and then acquire a mortgage servicing platform. The bold approach offers more than enhanced technology to the customer. It offers a whole ecosystem to research, to buy, to sell, and even finance real estate. Before the merger, Mr. Cooper serviced one of 6 mortgages in the country. So, will this new mega company crush the competition and render loan officers unnecessary? I doubt it. I believe there's more substantial change remaining in the hands of the user, not the producer. The bigger picture is that you are your next loan officer. Now, after more than 20 years in the mortgage business, I confess I've been mistaken about much of it. I remain stubborn to the idea that technology, mostly AI, will replace mortgage personnel. But I remain open to the concept that my utility dissipates as my client's education in the business increases. The transition's inspiring. It's not depressing. Yes, technology will continue to improve communication and accessibility of the mortgage, but the real impact on the industry is when lenders provide you with the tools to write your own loan. In essence, this will benefit the business twofold. First, by reducing the friction of originating a loan for the client, and second, lowering the production cost for the lender. The trajectory of technology in the mortgage business is always miscalculated. My career began in the early 2000s, and I recall on a job interview I had with the owner of the loan brokerage who predicted that technology would eliminate the need for loan officers and that within 5 years' time, we'd all be able to get our loans from the ATM. The idea was that as technology advanced, the need for mortgage consultants would decrease. I completely disagree with this notion as I view the loan business not as a product business, but as a service business. The product offerings are extensive, the guidelines are nebulous, and it's impossible to create a logarithm to understand how people manage and make their mortgage payments. Today, the loan business needs fewer people, not because of AI, but due to interest rates. And what is significantly proved in the past 20 years is the client's know-how, a better understanding of how mortgages work, market rates, and reasonable associated cost of borrowing. In the 90s, lenders made huge sums charging origination fees. Clients are way more savvy. They understand a loan estimate and they understand an APR. While they may not understand underwriting guidelines, ditto for loan officers. They don't either. Further, clients in 2025 understand the risks, the nuances of an interest-only product, and can calculate a payment as well as anyone in the business. Mortgages have become commoditized when we introduce education, not technology. And I'm not sure what industry benefits more from technology, medical or mortgage. But more tech doesn't always improve the process. Demand for manually underwritten loans is waning. The human risk assessment is less effective than computer-based risk assessment, and despite the model of more backshop tech equals less cost, the higher manpower continue to increase and make it difficult for lenders to turn a profit. Indeed, the ongoing recession in the mortgage industry is going to change the business. The moral of the story is that I'm not losing my job to AI. I'm losing my job to you. It's clear to anyone that the housing recession is in full effect. Just ask any realtor. Sales of existing homes have decreased by 35% in 2024 compared to 2021, totaling about 4 million homes. It's the lowest level in the past 30 years. Lower home sales most always mean reduced mortgage volume, and one chart illustrates this perfectly. Take a look at employment at non-bank mortgage lenders. It's dropped by 37%, falling from about 292,000 employees in June of 2021 to 183,000 by June of 2024. This marks the smallest mortgage workforce since 1997. As interest rates rose, mortgage applications have plummeted. Home purchase applications are down 40% from 2019 levels and 48% since 2021. Meanwhile, refinances have declined by 80% since 2022. While some might assume higher rates lead to greater profits for lenders, it's not the case. Lower volume results in reduced revenue, requiring fewer personnel, fewer underwriters, processors, and originators to get to next month. Overall, the loss of the 150,000 mortgage jobs is a drop in the labor bucket. Unemployment's low, and jobs still remain abundant. The remaining 180,000 jobs represent a smaller workforce compared to the post 2008 recession. Before the '08 crash, 340,000 people were in the industry, and although the previous loss was larger by volume, the recent people purge is more impactful due to the tenfold increase in automation over the past 16 years. Today's lenders can collect your pay, your bank balances, without you ever providing the documentation. This is a significant advantage for back-end processing. It reduces the time to close a loan from weeks to days. However, the mortgage business needs to evolve on the front end to eliminate the loan officer. Until we put more emphasis on educating the client, you still need me. In the last 5 years, many major banks and non-bank lenders have adopted either proprietary or third-party technologies throughout different segments of the operations chain to enhance the process and increase the customer satisfaction and experience. The extensive range of steps includes modernizing front-end applications, extracting and managing documents, third-party verification of income and assets, employment too, also overseeing appraisals, signing documents via e-closing, automating compliance and underwriting. These software solutions aim for more than the customer experience. The chief purpose is to reduce costs for lenders. Rocket's mantra is that you can apply for a mortgage online and get an approval in minutes. Progress has been made, but challenges in the execution still persist. The acquisition by Rocket gives them a larger mousetrap, but not a better one. Truth is, many lenders offer the same automated approval, they just don't spend millions marketing it. The kink in the mortgage armor is that we continue to perform these labor-intensive and repetitive fulfillment and servicing tasks despite the opportunity to automate over half of the activities through the front to back end processes. Not streamlining these outdated practices can lead to increased origination costs, longer cycle times. Also, when the demand surges, especially during refinance booms, many originators struggle to capitalize fully due to their inability to scale operations swiftly. The production's cost on a per loan basis continue to increase despite attempts to reduce these expenses by downsizing staff, and lenders have seen limited success with it. A 2023 survey revealed that 85% of mortgage executives felt that companies were unprofitable or barely breaking even due to escalation processing costs. Perhaps the Rocket Mr. Cooper is doing everyone in the business a huge favor, forcing the competition to eliminate these efficiencies or get out of the business entirely. The era of wide margins and high production volume is over. Currently, lenders face a mix of rising costs, reduced revenues, and shrinking incomes and margins. Freddie Mac's data shows that the average origination costs have surged by 35% in just the past 3 years. In the third quarter of 2023, the average cost to originate a loan was about $11,600, marking an increase of $2,400 or about 26% more than during the last downturn in the fourth quarter of 2018. In terms of production and volume, 2018 and 2024 are quite similar. However, when comparing the third quarter of 24 to the fourth quarter of 2020, a period of low rates and high volume, the situation doesn't improve. Costs during that time actually rose by an average of $3,000 per loan or 35%. Industry leaders recognize that to remain competitive, they must reduce the friction involved in loan origination. Embracing a digital process could result in cost savings of up to 40% per loan. Although rising production costs are not new, for the past 3 years, these costs have surpassed revenue, leading to significant losses for the business. Reducing production costs, including the role of the loan officer, benefits both lenders and its clients. While artificial intelligence, blockchain, predictive analytics play roles in digital transformation, the true change requires lenders to provide their clients with the autonomy to get their own loan when and how they want it. If lenders want to make more money, they need to lend more with lower overhead. Just makes sense. Understand that the opposite's happening today. The average lender origination fee, excluding points, is more than $1,500 compared to around $1,000 in 2019. Thus, more technology does not necessarily mean lower costs for the consumer. There's recent speculation that the Trump administration might consider privatizing the mortgage giants Fannie Mae and Freddie Mac. The potential privatization of Fannie and Freddie, like any business, comes with both benefits and drawbacks. A major advantage would be increased efficiency driven by profit motives. Privatization could lead to lower costs and stricter financial controls, but it also might bring new market sources as private owners are likely to invest more capital than the government ever could, potentially resulting in more innovative products and a broader range of choices. Products typically reserved for regional or large banks, such as home equity lines or construction loans, might offer additional mortgage solutions. Half of the challenge of the mortgage market today is finding the right lender that fits your needs. Most clients don't know where to access a construction loan or a home equity loan since they're specialized programs. Think about it. If the product is more abundant, there's a better chance that it'll be utilized. It's hard to benefit from an interest only home equity line when your primary bank doesn't offer it. It's nearly impossible to get an adjustable rate mortgage in this market, especially for a conforming loan today. This is partly due to the yield curve, but also due to investor appetite. Not having this product is limiting the choices for the consumer, which is one of the fundamental reasons why home affordability remains at all-time lows. However, the likelihood of privatization occurring within the next 2 years seems low, indicating a shift in market dynamics. On the other hand, there is a risk that could limit mortgage options, potentially favoring adjustable rate mortgage products over fixed rate loans. We see this all the time in Europe. The mortgage industry remains challenging, often leaving banks struggling to do its time consuming and labor intensive nature. And private investors may soon realize the difficulties of turning a profit in this business. Technology provides a huge opportunity for the DIY crowd, the do it yourself folk. Think of all the ways technology has provided education and exposure to industries once controlled by insiders. Think of the many things made possible by the smartphone. It's not only the arts, it's the production of this video, but also finance. Think of all the apps out there that allow one to self direct investing, like Robinhood, or even self prepare your taxes, like TurboTax. It's estimated over 40% of Americans self prepare their taxes, and for good reason. The technology is available, and certain changes in the tax code promote it. For example, the Tax Cut and Jobs Act of 2018 increased the standard deduction, reducing the route of itemization and the need to navigate tax filing without extensive expertise. It's no wonder why accounting enrollments are down and master enrollments are down 4 and 6% respectively. Even CPA examination candidates have dropped by 7%. Ditto for the financial services business. The total number of broker registered dealers, according to FINRA, has fallen every year since 2011, while the number of registered representatives has fallen every year since 2016. Loan officers don't require anywhere near the same of credentialing as a CPA or CFP. Lenders are not the gatekeeper they once were in the past. Today, there's fewer avenues for new loan officers to enter the business. Banks are decreasing their brick and mortar locations, having less of a need for tellers and client representatives that once represented the farm system for full-time originators. Financial services are becoming self-services. The opportunity for lenders lies not in the acquisition, but in the evolution of the business. Today's lenders' relationships are being shaped by the end users. Baby boomers and Gen X clients are accustomed to a comprehensive application process. However, millennials and Zoomers, a manual underwrite seems burdensome. Rocket Mortgage embodies this shift with their push button get mortgage tagline. They've taken advantage of the automated underwriting, which uses a computer logarithm to assess your loan. This logarithm evaluates the information you provided the system and determines if you meet the lender's minimum standards. The automated system compares your credit score, your DTI, and other factors against the loan requirements and guidelines. The machine handles most of the work, leaving the underwriter with the task of verifying the input. Lenders favor automated underwriting because it's significantly faster and more cost effective than manual underwriting. Currently, 90% of all loans utilize desktop underwriting or loan prospector for approval, with less than 5% of the loans needing human intervention. Clearly, both lenders and borrowers see little value in a manual system. The key to bridging the gap between the current and future state is enabling clients to act as their own loan officer. The current system includes numerous safeguards that simplify the loan process. Clients are already involved in gathering and uploading their financial documents during the application process. The next step is to educate them about the available programs and products and utilize their ability to research the terms before applying. Most loan officers today don't complete the application, much of it's done online. Lending is a business that earns for efficiency, and one of the best and most cost effective ways to cut costs is by eliminating the loan officer role entirely. This approach will make rates more competitive and place more responsibility on the clients to shop around before applying and locking in an interest rate. Do you recall the mortgage through ATM I talked about earlier in my career? It never came to fruition, and rightly so. The business evolves internally, not externally. When was the last time you visited an ATM? For those 55 and up, stats show it's about 1 in 4. But those 35 and under, it's about 1 in 8. So, LOL, RIP, ATM. It's following the way of the payphone. ATMs and payphones aren't the tools people leverage today to spend money and connect with others. Tech should encourage freedom, not limit it. The business has made great strides in moving the production from outside in. The next big step is allowing you to initiate your own loan on your own terms. We will get there through education. I'm not concerned about losing business to Rocket, and I'm indifferent to AI. I've always told my clients, this is not your last loan. Now I have to tell them, I'm not your last loan officer. Let's look forward to all the days ahead when a loan officer means less me and more of you. Now, my only question is, how will these negative interest rates affect lending?